David Toyne is the Toronto-based partner of Steady Hand Investment Funds. Welcome, David.
Thank you, Pramod. Good to be here.
Now, in a sentence or two, what do you do?
At Steady Hand, or what does David Toyne do at Steady Hand?
Well, you can say both if you like.
Well, Steady Hand is a Vancouver-based and employee-owned investment management firm, and we spend at Steady Hand virtually all of our days working with individual Canadian investors, helping them to build portfolios of investment funds that really reflect the age and stage that they're at, and ultimately help them become better investors.
Okay, and what's your role at the company?
So my role is to run our Toronto office. I am our Toronto office. The other 9 Steady Handers are out in Vancouver. And I spend a large part of my day working with clients directly and helping them to become better investors and build investment portfolios.
Okay, thanks for explaining that. And one of the things that you do is create reports, and one that we have here is this particular one, and this is what we'll be asking questions about. We'll be looking at the 5 essential elements to being a better investor. Now, in your report, the very first element is to be realistic. What do you mean by that?
I think the first thing that we should really reflect on is why have we even done a report like this? Because this is hard work, investing. It's not an intuitive thing. So we really are trying to make it more an approachable activity. We're trying to make it more simple. We're trying to get people to become more engaged with their money and to take more of an active interest in managing their money. Because we know, and I brought a little collateral material, we know that investing is fraught with emotion and intuition, and I'm not sure if our viewers can see that or not, but here's a little piece from Carl Richards, who writes extensively in something called The Behavior Gap. And here we can see what typically investors experience as they go along between euphoria and greed and ultimate panic and repeat this process. So investing is full of pit holes. We want to simplify it, and we want to give people the 5 essential elements, the basic framework to become better investors. And now, why is this ultimately important? Because if you're more confident, if you're more comfortable in the process of investing, you're likely to have better returns. And that is ultimately why we're investing our money in the stock market or in the bond market, as opposed to stashing it underneath our mattresses.
Right. So when I read the report, I was quite impressed by it because it has good, solid content. It doesn't feel like a sales pitch. It just feels like good education. And I find that the best education comes from people inside an industry,
right,
because they understand the nitty-gritty. And I do appreciate you having taken the time to create this kind of a report.
So getting back to your question, what is the first of the 5 essential elements? Well, the first is to be realistic. And what we mean by that is individuals, we need to understand our own temperament. We need to understand our interest and knowledge in the subject of investing. We really need to figure out where we're going to fit into this whole scheme of things from our own personal perspective. We also have to be realistic about what markets, stock markets, bond markets, cash markets, what those can give to us over the long term. Because too many of us focus on what the markets have just done, the so-called recency effect. And we forecast or project that out into the future. And at this writing in August of 2014, the stock markets have done very, very well in the last 5 years. And so what we're doing is trying to help people become way more realistic about their own capabilities as well as what investment markets can deliver. And that's the #1 essential element, to be realistic.
Okay, and then the second element that you have is to have a long-term plan. And what does that mean?
So planning is pretty boring, but it's absolutely essential because you have to have a sense of grounding. After all, it's not about from here to the future in one straight line. We know in our own personal lives, as well as in our investing lives, there's going to be bumps in the road. And so having a fundamental basic plan that will get you through those bumps in the road is absolutely essential. It doesn't necessarily, for a young person in their early 20s, just starting in a new career, have to be extraordinarily complex. But it does have to address the essential elements of savings rates, asset mix, what we call the strategic asset mix, which is the blend of stocks, bonds, and cash that make up a portfolio. And it could involve the use of an external resource like a planner. We advocate the use of what we call fee-for-service planners, where investors are actually paying somebody for that advice, much like you pay your lawyer or your accountant for legal or tax planning advice. And as you get older and as things get a little bit more complex, as you're starting to look at retirement planning, sure, estate planning, tax effectiveness, retirement planning, that becomes more insurance planning, that becomes more appropriate. But to have a plan is as simple and basic as a plan for a 24-year-old or a 55-year-old might be, absolutely essential.
Okay, and then the third element is to commit to a routine.
Mm-hmm. So we know that money and emotion don't mix, just like gasoline and matches. And so committing to a routine is really taking the emotion out of investing. There's been a number of studies done by firms like Dalbar and Morningstar that demonstrate there's something called the behavior gap. And that is the difference between the performance that an underlying investment, whether it's a mutual fund or an ETF or a stock, performs, and what the investor in that fund or stock actually experiences. And that gap can be as high as 4 percentage points a year, which is pretty dramatic. Those are Dalbar studies of U.S. investors in the U.S. Stock market. And so how do we address that behavior gap? Well, let's try to detach emotion from money and put more of a routine in place. So routines involve rebalancing, for example.
Okay.
We've identified through our planning exercise a strategic asset mix. And as different return criteria and characteristics from different investment experiences play out, we're necessarily, in all probability, going to be out of balance to our long-term asset mix. So what kind of routines can we have in place to bring us back into rebalance? Well, one of them is to use, when you're accumulating money through your RSPs and your TFSAs, to use those contributions to rebalance back into the appropriate asset mix.
Okay, so not necessarily selling things, but using this fresh cash to invest.
As an example.
Okay.
Or you might have to, in fact, look maybe once a year, possibly twice a year, but no more than that, at selling. You may have to trim your winners and buy more of your so-called losers. So today, for example, as I say, in August of 2014, this is probably a good time for people to be, if they haven't already, be looking at that rebalancing exercise, because in all probability, equities having performed so well in the last 5 years, they'll be out of whack with their long-term asset mix.
Okay, and the element 4 is to prepare for extremes.
Right. So as in life, there are bumps, and some of those bumps can be pretty big. And certainly in investing, well, we expect over the long term stocks to beat bonds and bonds to beat cash. Along with that expectation will come a heightened level of volatility, or a heightened level of up and down for stocks, less so for bonds, and very little for cash. So you really need, in order to prepare yourself for a better long-term, higher rate of return from your investing, you have to prepare yourself for that level of volatility. And 2008 is obviously the one of most recent memory. 2001, of course, the dot-com crash, and 9/11, also fairly recent. And obviously the huge issue back in the 30s with the major depression. So these are all periods of extremes, followed by periods of opposite extremes, rebounding in the markets.
Right.
So we just want people to prepare for that and recognize that it's all short-termism and it's all noise, that for a long-term investment plan might create an opportunity, but it really should probably be just that, noise.
Okay, and then the fifth and final element is about taking charge. You're the boss.
Right. So you're the CEO of your portfolio. We're really very happy with clients that are prepared to delegate the responsibility of managing their money to an investment professional like Steadyhand. But I think one of the challenges that we have as a society in Canada, with this looming financial crisis, with financial literacy issues, is there's probably a little bit too much apathy. You're not delegating, you're abdicating. And we're really trying to say to people, it's your money. Nobody cares as much about this money as you do. And it's really important that you rise to the occasion and just take a little bit of time to become better engaged, better disciplined, better aware. And it's as simple as understanding, what is your asset mix? You know, what should it be?
Mm-hmm.
What do you own today? How are you doing relative to the context of how investment markets and perhaps competitor products have performed, and how much you're paying? Because there's only one certainty in all of this, and that is the cost. And that's controllable. You don't know what the markets are going to generate going forward in terms of returns.
Mm-hmm.
You know that there's this sort of stocks beat bonds beat cash over the long-term perspective.
Right.
But you definitely know that fees, costs, are negative returns. They're drags on your portfolio. And so if there's this age-old concept that in retirement you can withdraw 4% of your portfolio, and that's a sustainable withdrawal rate, in other words, you won't run out of money, well, remember that 4% could be 5% if you trim your fee by 1%. And 5% in your genes is a better lifestyle in retirement.
Right, because compound interest is magical. It works very well when it's positive. But when you have a decrement, then the compounding works against you in really severe ways.
Exactly. So we're just asking people to take some time out to gather their documentation together and to figure out if they need help, to go and get that help. And I refer back to the fee-for-service planner as an example. There's tons of great bloggers. Pramod, you're one of them. Preet Banerjee, Rob Carrick, there's great books out there. Just spend a little bit of time to get engaged and figure this out. And we're happy at Steady Hand to have a conversation with anybody that needs some guidance on that as well.
Okay, so thank you for sharing those 5 elements with us. What's the best way for people to reach you?
Well, our website is really the source of all things that Steady Hand produces, and you're right, we produce a lot of content. So our Steady Hand address is www.steadyhand.com. We love to hear from people, and we've made it simple with a toll-free number called, which is 888-888-3147. And we actually answer that phone from 10 a.m. Toronto time to 8 p.m. Toronto time, which is, so we're on sort of 7 a.m. West Coast time to 5 p.m. West Coast time. Or to write us at info@steadyhand.com.
Okay, well, thanks for dropping by.
Pleasure. Thanks for having me.
Thanks for joining us for Tea at Taxevity. The Taxevity Insurance Advisory helps you understand insurance and bridges gaps in your coverage. There's no premium for peace of mind. How healthy is your insurance?